Welcome to the Investor Download. I'm your host, David Brett, and with me in the studio is Senior Strategist Andrew Rymer and Senior Emerging Markets Economist David Rees. Welcome, both of you.
Thank you, Dave.
Thank you.
How are you both doing?
We're good.
Fantastic, thank you.
Okay, superb. Well, let's get straight to it. You've both been busy crunching the numbers and you've come up with some research on the globalisation reset, in particular, what it means in terms of which economies and which markets are set to benefit. We'll get to who those winning economies might be and whether that equates to winning markets shortly. But first of all, before we get into what we mean by the globalisation reset and the evidence for it, I just wanted to get an idea of what we're resetting from. So in other words, what did the world look like before the reset began?
In a nutshell, we're thinking about this is a rewiring of global manufacturing supply chains. You might have heard the terms nearshoring, onshoring, reshoring, reglobalization, slowbalization. There are a range of terms out there. Ultimately, what these are all referring to is some form of supply chain diversification or reorientation, one might say.
Okay, so before the reset, where was that focused on?
Do you want to take that on?
Well, I mean, since the sort of 90s, we've been through a period of globalisation, right, where trade as a share, world trade as a share of GDP has been rising. We've seen a shift from manufacturing in the West to China predominantly, but other emerging markets as well, where companies have been looking for cheap labour as a way to bring down the cost of production, to widen their margins, etc. So we saw a long period, particularly after China joined the WTO, which really turbocharged this shift in manufacturing production located in Asia. We kind of feel like we've reached an inflection point in that.
Okay, so let's talk about the globalisation reset itself. What do we mean by that?
So if you think back to this period of globalization, which really accelerated in the 90s, as David was saying, companies at the time, the sort of driver of the globalization was, multinational companies looking to lower costs and become more efficient. And that led them to shift production to cross-border, so into other geographies. So this was really that they were attracted to large pools of lower cost labor. And one country at the time, China, was particularly attractive. And to give you an idea, in 1995, China's working age population of around 830 million was roughly double that of the G7. And if you look at wages, the cost of manufacturing wages in China at the time was around 40 cents per hour. If you compare that with the average across the G7 of $17 per hour, you can. It's quite a significant difference. So companies, this was sort of driving the attraction through the 1990s, as David said, and talked about China's joining the WTO, and this led to this sort of supercharged period of export industrialization, and China became the dominant manufacturing hub of the world.
Okay, so we had a period where suddenly the world had this extra huge workforce, so that's a lot more people buying goods, and also it had the rest of the world had this sudden access to cheap labour as well. What did that mean for companies? Was it just purely them taking their production costs abroad, or were they making other advantage out of that as well?
Well, I mean, the obvious benefit of the short term was a massive reduction in labour costs, as we just said. I mean, labour costs in China at that time were 2% of those of the G7, so there were huge savings there. That pretty much led to global goods deflation, actually, for quite a long period. So if you think about that run through the early 2000s into the global financial crisis, economic activity was booming, but actually inflation was quite low, and you had this massive goods deflation, which allowed people, even if there wasn't particularly strong wage growth, they could buy more stuff with the money that they had. So that was obviously good for sales volumes of multinational companies as well. And that they were also able to then tap into growth markets like China for the future, because not only could you set up shop in China to reduce your cost of production, but you also then got access to a huge growth market for the long term. So it was kind of a win-win, I suppose, for multinationals at the time.
Okay, so we're talking about a reset. So what's happening now?
Yeah, so there are two factors driving multinationals to reassess their global supply chains. The first really is just diversification. The COVID pandemic highlighted the risks of concentration, and you saw huge disruption, dislocation and bottlenecks in supply chains for several years through the pandemic. And this was a reminder, served as a reminder to multinationals of having sort of all their eggs in one basket, or at least being insufficiently diversified. And we talked about in the 90s, this driver of globalization being focused or led by a focus on efficiency and cost, whereas today the focus is increasingly on resilience and reliability of supply chains. And there's a second factor which sort of emphasizes some of the points we've already discussed, which is just geopolitics. Geopolitical tensions between the US and China predate the pandemic by several years, but have continued to escalate. And as I say, emphasize many of the risks we've discussed.
Well, I think that's an important point as well, because if you think about the deindustrialization of countries like the US, Europe, UK, companies moving facilities out to China, of course, that sowed the seeds for a kind of disaffected working class, if you like, which that was seized on by populists like Donald Trump. And of course, how did Donald Trump get elected? When he got votes of the Rust Belt by bashing China. Pretty popular. That's going to continue for a while longer, isn't it? Particularly with the election next year. And so I guess, to me, that was the big driving force. And then that was magnified by the pandemic with shortages because of shutdowns of factories, absence of goods, etc.
Yeah, okay. And what does that, we talk about how big China has been in this globalization, in this reset. What does that mean for Chinese manufacturing?
Well, it's difficult to judge, isn't it? Because on the face of it, you would think that this would mean the end of Chinese manufacturing, that it's had its heyday, it's produced loads of goods, and now all the companies are going to leave, so manufacturing is going to nosedive. It's probably not that simple, because at the same time that companies are thinking about relocating away from China, and we'll come on to discuss about whether they actually leave or they set up parallel operations. But at the same time, there's an industrial revolution going on within China to move away from low-cost, labour-intensive manufacturing to move up the value chain. And we've seen it now start to dominate the production and export of motor vehicles, electric vehicles. We're seeing that it's a dominant force in the production of goods related to the energy transition. So there's an evolution going on within Chinese manufacturing, and it's also trying to bring onshore more of the value add because of trade sanctions, tensions, a drive to become self-sufficient. So it's not the end of Chinese manufacturing, but it's certainly driving a big shift within it.
And have we got any evidence of this globalization reset actually happening? Is there anything showing up in the data at the moment?
I mean, this is the rub, right? Because it's so early. The story seems to hang true. So if you look at earnings transcripts from certainly US or multinational companies, there's been a huge pickup, companies talking about reshoring, etc. We've seen anecdotal evidence of, particularly in, say, the semis sector, where companies are facing sanctions, announcements of investments in the US, announcements of investments in Europe, etc., moving away to some degree from Asia. Of course, partly because of geopolitics, partly because of massive tax incentives, etc., they're receiving. If we talk to our credit analysts, say Latin America, real estate, commercial real estate in Mexico along the border is booked out. You've got capacity pressures. So it does seem like something's happening, but it's going to be slow moving. And so to see it in the data is going to be a while, because you're going to be looking for things like FDI flows, increase in construction of real estate, commercial real estate, increase in manufacturing output, export, but it's going to be slow moving. So certainly the early indications are there. And now we're looking for the follow through and it will be a matter of years rather than months.
FDI, foreign direct investment.
Yeah.
So you'd expect that to flow out of China if that was the case.
You would expect at least a reallocation away from China and a pickup into some of these countries that we've identified as potential beneficiaries.
Yeah, because I've got to figure out, it said macro numbers show that 2022 was an all-time record year for world trade. So yeah, that's a backward-looking one, but how do we explain that?
It is a backward-looking one, and certainly Chinese exports to the US hit a record in dollar terms. I mean, it's a bit funny, right? Because obviously nominal numbers rise over time, and we've been through a burst of inflation with goods prices going up.
Yeah.
So that's distorted. If you look at it as a share of China's GDP, China's exports to the US, they kind of peaked out around 10 years ago. If you look at it from the US side, it's a similar kind of period. So in nominal terms, it's rising. The numbers will keep rising over time, but as a share of GDP, things have at least stabilized after a rapid period of growth.
Okay, so that's part one. That's what it was before this reset and what it might look like around the reset. In part two, we're going to look at who are the winning economies. So let's start with you, Andrew. So you both have put together this excellent research document, and you created a nice little league table as well. We'll go into a little bit of that shortly. But which economies might be the beneficiaries of this global reset theme?
Yeah, it's the great question. To think about this, we put together a scorecard ranking to try and assess which might be the most attractive economies for multinationals thinking about this theme. So we used 4 factors of a wage proxy, working age population by 2028, total growth in total factor productivity over the last 5 years, and business freedom. Now, there are obviously one caveat to this scorecard is that there are obviously a lot of other factors and nuance to consider, but this provides guideline framework to think about this theme. Now, the top ranking economy was India, followed by Vietnam. Now, which factors were supportive of their ranking? Working age population by 2028 for both, but for India, it is forecast to have the largest working age population in the world and ranks top on that factor. That was supportive. And then others were also the growth in total factor productivity in both of those markets. And business. The one sort of drawback was on business freedom, where they didn't rank as highly, but that's the main drivers of theirs. There's others in the top 10, including other Asian markets, include Korea and Thailand. And then in Central and Eastern Europe, you have 4th of ranking was Poland, interestingly, and then Germany, Romania are also in the top 10, with others closely following. One thing that comes out from the list I've just provided is that a lot of these economies are in emerging markets.
Mainly emerging democracies in those markets.
Yeah, I guess so.
Yeah.
I guess so. But I mean, surprise, we did all this work and India came out top because it's got an enormous population of cheap labour.
Yeah.
Which is what China had at the beginning of its period of rapid industrialization.
And we've been talking about India as this burgeoning economic behemoth for quite a while now. Are we at the stage yet where it's ready to take on that mantle that China once had?
Well, this is the big question, isn't it? Because India has had these basic ingredients for a long time, a long time. And probably what's got in the way of India seizing, grasping the nettle and becoming a manufacturing hub, I guess one is that China was being so successful. And why was China being successful? It's second reason, the policy making. So there's work to do. I think with the Modi government, the promising thing is that the government is, even though Modi's been in power a long time, he's maintained at least some momentum of reform, which is unusual. Usually when someone's been in power a long time, reforms dry up and you concentrate more on staying in power. So there has been some momentum, but I guess what the key difference this time is that there's also a stick for companies to look for new locations because of the decoupling and geopolitical tensions, etc. India, on balance, being more of an ally of the West, I guess, these days than China. So there is more of an incentive for companies to look for a new location. And as we said, if you go on the basis of availability of labour and the cost of that labour, then India stands head and shoulders above other competitors. So there is also the kind of stick as well as the carrot now. But a lot's still going to come down to policy making, I think. And other factors as well, like, energy generation. Can India generate enough power cleanly to supply the companies, etc.? But that's getting more into the weeds of it. The basics are there.
Yeah, absolutely. And we should say that if people want to find out more, go to the full document. It's schroders.com/insights, or just pop in your search engine, globalisation reset, which economies and markets are set to benefit. But just on that, so if India and lots of emerging markets, especially in Asia, around the top of that list, what does that mean in terms of supply chain reorientation for multinational companies?
So this is a pretty big question. It's quite a big unknown, because in theory, you could imagine a world where companies just up sticks from China and move to India, or move to Central Asia, or move to Mexico, build a new plant and carry on as they were. Probably things are going to be a little bit more difficult than that, because if you decide that you're going to leave China, there's a risk in the near term that the Chinese government make life quite difficult for you. You could go onto an export ban list, but you're also, probably more importantly, or just as importantly, going to lose access to the Chinese market in the future potentially. And, for all of the negative talk about China, it is still a huge economy. It is still one that's growing relatively quickly. That growth is going to come down in time, but it's going to be an important market in the future that companies won't want to lose access to. So when we did the work, certainly when I did some work a while back on this, it kind of stood out to me that probably you're going to end up with companies either running regionalized supply chains or a China plus one strategy to maintain access to the China market, actually to maintain access to the fact that China's manufacturing sector is supremely better than anywhere else at the moment. So you keep one foot in there, but then also diversify into another area. So probably you're going to end up with something like that. Now, for some sectors, that's been going on for a while. If you think about the car industry, it's quite regionalized. You've got Mexico serving North America. You've got Eastern Europe and Germany serving Europe. You've got China, Korea serving Asia. In real terms, car prices have been coming down, believe it or not. It doesn't feel like it. So some sectors are well suited to it. I think the production of fairly homogenous goods, if you're then running two plants instead of one, that feels more costly, less efficient. So I guess that's where it becomes a bit of a concern for the global economy and for the margins of multinationals.
And again, is there any evidence at the moment that some of these companies are starting to look away from China in terms of their supply chains?
Well, again, it's all anecdotal, isn't it? I mean, you get stories about, for example, Apple shifting some production to India, opening an Apple store, etc. So again, it's anecdotes. We are seeing diversification. I mean, semis is the obvious one, as I said before. Semiconductors is the obvious one, where the geopolitics is playing a big kind of role in pushing companies away. But then actually we're still seeing companies invest in China too. So that kind of plays to this dual supply chain.
Okay, and have we heard anything from China on these potential supply chain issues or manufacturing moving away?
So less so, I would say, because China has not wanted to. It's kind of been quite neutral in its reaction, I would say, into a lot of the stuff that the US has certainly been doing in terms of trade sanctions. It hasn't been out kind of beating the drum too loudly on it, if you like, almost wanting to not play the victim, but, certainly not be the aggressor. So not so much, but then you do see the reaction of Chinese policymakers, as I said, to become self-sufficient. So, really wanting to push resources, time, effort, money into things like semis themselves to become self-sufficient and generate their own goods to replace the ones that they're losing. So I guess that's more the way that we're seeing the reaction at the moment.
Okay, so the winning economies seem to be India, Vietnam, and emerging markets, especially in Asia. Let's move on to what that means for markets. Does that equal winning markets? So, Andrew, to you first. If, let's say, India have got a winning economy, does that automatically equal them having a winning market?
Yeah, I think there's this common belief that strong GDP growth flows through to strong equity market returns. That's not always guaranteed. And there are a few reasons for that. GDP as a measurement can suffer from issues in terms of data quality and measurement. Corporate profits as a share of GDP can fluctuate through time. Equity issuance can dilute earnings per share growth. Then valuations today may already reflect the opportunity that this theme has potential to deliver, i.e. it might already be in the price. And then the sector makeup of the economy and the equity market can differ. So the opportunity to invest in related sectors may not always be present in all of these economies.
And we see that in the UK, right, David? UK economy struggled, yet the FTSE has been up and around record highs for the last year or so.
Well, it's stuff full of commodity producers, isn't it? They're earning from the rest of the world. Yeah. Exactly. I mean, that clearly is an issue in terms of the sectors. We tend to see it in a lot of these markets, but then I suppose also on the valuation side, India, for example, we've found India to be the most likely beneficiary of all of this. But of course, the stock market's always quite expensive. There's a premium in there for future growth.
And I guess difficult to access as well for foreign investors.
Somewhat more difficult than others, I would guess. Yeah.
Okay, so Andrew, I mean, what does this mean for investors? How might they capture this opportunity?
I mean, the first thing to say is that this is a long-term, multi-year theme, and there's significant nuance. We've already discussed it with regards to the relationship between the economic scorecard and opportunity versus the market. So there's a lot to consider. I think, as we've said, the majority of economies and markets that we flag in our research are as beneficiaries are in emerging markets. So you would think that for an active emerging market manager, there ought to be the opportunity to capture this theme, at least in theory, because they can deploy their approach to analyze and to filter out the sectors and stocks where this theme may be most prevalent. But it's not just in emerging markets. There are some developed markets that rank highly. And I think it might be, I would sort of make a contrast between, we talked at the outset about emerging economies being attractive in the 90s through this period of globalisation due to higher pools of labour, which was also lower cost. Whereas today you may find that while that still may be applicable for some of the opportunities in emerging markets, in developed, it might be that these are more smart manufacturing focused.
I actually should have asked earlier, was there any countries in that table near the top that surprised you that were in there in terms of this globalisation reset and who might benefit?
Well, I think the surprising ones, because we weren't necessarily aiming for it, was the developed markets, wasn't it? So that's already a slight surprise. And I guess that to some degree supports the notion that at least some of this diversification will come through reshoring. Probably won't be labour intensive. It will be fairly automated, the use of robotics.
Yep.
That will help with the productivity sort of puzzles in some of these economies. So I guess that was one surprise. I guess the other surprise, not necessarily a surprise, but obviously we have to sort of acknowledge that China still ranks very highly in all of this. And as I kind of touched on before, it might end up being a China plus one strategy because China is a supreme manufacturer and people will be reluctant to give that up easily.
Yes, because I guess if you just read the headlines, obviously the trade wars with China and the talk of people coming away from China because obviously what happened during COVID and everything, and yet China still looks like it will benefit from this globalisation reset.
Yeah, as we said before, there'll be an evolution, right? China's manufacturing sector isn't going to go away altogether. It's just too powerful, too productive to go away altogether, but there will be a shift within it.
Yeah.
I think the other point to make is that Mexico, which is so often referenced in relation to this theme, only ranks 17th in the scorecard. And as I said earlier, there's some nuance here and there's other factors to consider. And ultimately, the scorecard doesn't take into account the fact that geography and the fact that Mexico sits on the border of the largest economy in the world.
With a free trade deal. Yeah.
Okay, so basically what you're saying, I shouldn't cash in my very expensive mortgage and put it all in on India.
Not at the moment, David.
Maybe in 10, 20 years' time. I'll come back to you after that. Andrew, David, thank you so much.
Thanks.
Thank you.